You are listening to Mining Stock Education.
Looking at my own performance over 40 years, I am an average allocator in oil field services and supplies, and I'm a good allocator in upstream. So I prefer to be where I'm a good allocator. The U.S. names I give you a median 3.75% current yield dividend. The Canadian names I gave you give you a 6% basic yield. So assuming that I'm early, which I almost certainly am, the time value of money objection is obviated by the dividend.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers, and today you're going to hear from the one and only Rick Rule from Rule Investment Media. Rick, thanks for coming back on the show. You've been traveling. You were in London, so I appreciate you taking the time. And I have a question for you about where you've made the majority of your money when it comes to junior miners. Has it been what you refer to as the easy money off the bottom, where you get positioned in advance, and that's the majority of the profits that you see in a commodity upcycle?
That's a complicated question. I have made the majority of my money backing very high quality people, where my entry took place during bad markets, which is to say where they needed me and the market wasn't competing with me for stock allocation. And by the way, the vast majority of my money has come about from fairly few of the overall allocations that I've made, which is to say that probably 10% of my starts made me 85% of my money. The big winners, it's important to note, have all involved good people, unpopular entry times, long holding periods, and the ability or willingness on my part to subject myself to a lot of volatility. Specifically, I don't think I've ever had a 10-bagger, or if I have, I haven't had very many, that didn't expose me to a 50% decline in share price during some part of the period that I held the stock. So I would say really the lessons are persistence, tenacity, a focus on high-quality people, the willingness to write checks during depressed market conditions, and no interest whatsoever in small projects.
Rick, over the last few years, I've listened to you tell the market when you take money in your uranium juniors, even when many are still bullish. Right. You say you take money in some of your gold and silver. So when do you reach what you call the point of no concern, where your initial capital is off the table, you leave a little there to run? Like, do you have any rules of thumbs that guide your investing in that regard?
I don't. It has to do with competing opportunities. In other words, I try to shift my money to where I think the risk-adjusted opportunities are the best. I was going to say I've got too many thumbs already, but we'll leave that alone. The easiest money to be made in the juniors is the hate trade. That's the easiest money. You'll recall interviewing me some period of time ago when the junior silver miners were absolutely hated. After the aborted silver squeeze, there was a huge constituency that had come into the silver, bid up all these things, capitalized the company, and then fled them in mass, hated them. And the silver juniors were stupidly cheap because people hated them. They had no momentum except downward momentum. And the social media was replete with disgust. We saw the same thing in the uranium business. The easiest money to make is to buy hate. And if you have that as a strategy, even though there's room left in the stock, when the stock goes from hated to tolerated, you take enough money off the table that you get the rest of it for free. There's a strange saying on Wall Street that there's always a bull market somewhere, which is a different way of saying something's always overpriced. The corollary to that is there's always hate somewhere. And so you need to monetize part of the hate trade. It's really important to do. The other part of selling the second part of selling always has to do with valuation. whenever I buy a position in anything, big or small, whenever I make a loan, whenever I do anything, I write myself a one-page handwritten memo about why I did it, what can go right, what can go wrong, what my target is, and what will cause me to sell, both in the good side or the bad side. And I revisit those memos. It's important to remember why you did something, what your time frame was, what your state of mind was, what's changed. So valuation matters a lot to me. If I think, let's say that I think the current valuation of a company, and this is subjective, of course, is $100 million. And let's say that I believe that there is an unanswered question chain that has the possibility of the company being worth $500 million in 5 years. If I have the opportunity to buy that company at 150 million market cap, if I like the people, a 50% premium to valuation, with the anticipation, of a 5-year triple, I'm probably okay with that. What happens in bull markets is that you get the price appreciation that you've hoped for over time before the unanswered questions are answered. At that point in time, you sell enough stock that you get the rest for free. You absolutely positively do that. And if you've already done that, which is to say, if you're already in the free ride position, you look at the money you have tied up in that stock relative to other opportunities that the market hasn't recognized, and you allocate capital according to what you think the best outcome for you is. Warren Buffett has talked about this at length. Warren Buffett says that you structure your portfolio like a small hog farmer. There's a certain elegance to that statement. And your portfolio, your cash is the trough. And you decide that there's room at the trough for 10 pigs. If you decide that you're going to introduce a new feeder pig to the herd, you got to sell off an old fat one. In other words, you allocate your money according to, in your mind, the best juxtaposition of risk to reward. Many people won't do that. They hold on to stocks because they've gone up. In other words, as the stocks are less cheap and less attractive, people want to hold them, which is pretty silly.
When it comes to opportunity cost, I invested in a few private miners some years ago.
Yep.
Rick, they're still private. They haven't successfully gone public, which means they're illiquid. So I think about my opportunity cost had I been in just some of the major producers in the gold and silver sector, and what I would have done, tripled my money with less headache. Can you share some of your insights on opportunity cost that you gave up making a mistake, such as perhaps I just did?
Well, it's lovely that you talk about that, because I believe that you've had a pretty successful 10 years, despite your modesty describing your mistakes. What happens after 10 years is that beta becomes more attractive to you than alpha, which is to say, if you believe that we're in a gold bull market and the bull market has some legs, the first thing you want to do is make sure that you participate in that market with as little risk to you as you can. If you believe, like I believe, that the gold price will do well for 10 years and that a composite of gold stocks will appreciate at roughly double the gold price, the first thing that you want to do is capture as much of that beta as you can with as little operational risk as you can. And you speculate with what's left over. I believe that, and this is for educational purposes, don't take what I'm going to say next as gospel, but I believe I'm predicating my portfolio assumptions on the fact that the US dollar loses 75% of its purchasing power over 10 years. In an absolute sense, not a relative sense. I don't mean relative to the Canadian dollar or the Australian dollar. I mean, absolutely. I mean, Bill, you and I as Americans will lose 75% of our US dollar purchasing power domestically over the next 10 years, I believe. As a consequence, I think it's more likely than not that the nominal gold price, that is the gold price priced in US dollars, will increase roughly symmetrically with the decrease in purchasing power. So I'm suggesting to you that over 10 years, I believe the gold price will triple. And I believe that the gold equities in composite will double the move in the gold price. 500 or 600% over 10 years is a pretty good return. I don't feel the need to amplify that return too much by taking a whole bunch of alpha risk. Where I take the company risk, in other words, I risk losing money even though the gold price triples. For the bulk of my gold portfolio, which is to say my non-bullion portfolio, I have my bullion in a different basket. I'm in names like Franco, Wheaton, and Agnico, where I believe I'm taking no enterprise risk and no management risk and capturing as much of the gold beta as I can. I'm also, as you know, an alpha speculator, but I do that in a different part of my portfolio. I suspect that a lot of your new subscribers are purely alpha chasers. They've seen some of the penny dreadfuls absolutely scream. They've bought into the gold thesis hook, line, and sinker without perhaps thinking as much as they ought to why and what could go wrong. And they are searching for maximum upside, not the juxtaposition between upside and downside. And I hope that through listening to podcasts like this, they become somewhat more self-honest and perhaps more discerning.
Rick, when you were a broker, would your clients get more frustrated with you at times during a bull market than even a bear market?
Yeah.
And why?
A good broker, and I wasn't in that regard, is a good psychologist. He or she is a babysitter. Clients, oddly, psychologically, were more punished by foregone profit than they were absolute loss. Not just as a broker, Bill. As you know, I've been for free grading people's natural resource portfolios for 35 years. I'm told that I've graded almost 100,000 portfolios over 35 years. I've taught a lot doing that, but I've learned a lot too. I've learned what investors and speculators get right and what they get wrong. So it isn't just as a broker. As a broker, you have a smaller data set. And the people that you deal with more are disproportionately represented in your psyche. In other words, you're tempted to personalize the response and ignore statistics. With regards to the ranking database, we have in the database, we don't have the early years, but in the database, we have 60 some odd thousand rankings, timestamped. You can learn a lot by looking at that database, and I have.
So do you compare like that database relative to promotional spend or performance? Have you taken that and done any more studies? Any insights you can share?
Oh, I mean, all kinds of insights I can share. You can see investor greed and corporate larceny writ large. You can see companies that you knew at the time were worthless promotions. And the outsized impact that those promotions had on the psyche of speculators who didn't take the time to understand their portfolios. The other thing that you can see is the incredible increase in value that accrues to concentrated portfolios relative to diverse portfolios. One of the most common speculative mistakes I see is the tendency of speculators to follow the got a hunch, bet a bunch theorem, which is to say they get a tip from Bill Power, they get a tip from Doug Casey, they get a tip from Rick Rule, and that's sufficient to cause them to buy the stock. Gold is going up, so I'm going to buy Amalgamated Aardvark Explorations, which I learned 3 years later didn't have any gold. They were looking for it. I have asked people on your podcast, you may not remember this, but I've asked people to constrain the number of shares of different companies they own to the number of hours per month that they are prepared to spend working on their portfolio. And by working on the portfolio, I don't mean listen to Rick Rule. I mean reading quarterly reports, reading annual reports, reading proxy statements, reading insider filing statements. Any number of portfolios that I have graded over 35 years have had 100 stocks. And I know these people weren't spending 100 hours. The second most common mistake, Bill, is duration. I found that the vast majority of the people that I interviewed, whose portfolios I graded, had fairly sound strategies. But they had terrible tactics. The strategies that they were talking about could easily take 5 years to play out. But these same people had trauma holding stock over a long weekend. If you have a 5-year strategy and you're employing a 3-month tactic, it's problematic for you. The third thing is a lack of self-honesty. And this came through in the interviews I did. I've interviewed a couple thousand people because their portfolios amused me, and I wanted to find out more about the thinking that went into the portfolio. One would be that people are loath to sell a stock until they, quote, break even, which is to say the psychological torture is worth more to them than the financial torture. I'd go over somebody's portfolio with them, starting at the top, the A's. So let's make one up, Amalgamated Aardvark. And the holder would say to me, well, Rick, what do you think about Amalgamated Aardvark? I'd say, well, until this conversation, I was blissfully unaware of its existence. What do you think about it? Well, I don't think I like it. Well, why did you buy it? Well, I bought it because Bob Bishop recommended it. Well, Bob Bishop's been retired for 16 years. What do you think of it now? Well, I don't know anything about it now. Well, why don't you sell it? Well, I can't sell it. Why can't you sell it? I paid $4 for it. Now it's selling for 40 cents. And if I sell it, I'll lose it for $3. I'll lose $3.60. Then you have to say, no, you've already lost the $3.60. The question is, what are you going to do with the remaining 40? If you like it, you ought to buy more. If you liked it at $4, you ought to like it at 40 cents. If you don't like it, you ought to sell it and use that 40 cents for something else. You follow where I'm going with this, Bill?
Definitely.
People are not self-honest. And too many of them are lazy. And mercifully, I've had 50 years to learn how to do that myself. And I've had 35 years of compiling data about the mistake that other people make, which has been really useful to me in many regards.
So for the retail investors listening to us and they say, hey, I want to be in the sector. I want to have good service providers, so to speak. If they're looking at a newsletter writer, what is the proper role and ethical role of a newsletter writer in this junior mining ecosystem? And what should be some things they should look for in that newsletter writer?
In the newsletter writer, they need to find a technique of bias that they can identify with. In other words, the newsletter writer can't tell you what to buy. The newsletter writer could and should suggest investment themes and specific names. And you should know enough about the letter writer's psyche, the letter writer's technique, that you are willing to consider what he or she recommends. And you should know something about the person's pedigree. You should know something about their process. Is the letter writer a geologist? If not, do they employ a geologist? In other words, how do they make their decisions? And is that decision-making process something that you can't or won't do for yourself, but is it consistent with what you're trying to accomplish, the rewards you're seeking and the risks that you're willing to take? I have loved paying for newsletters because there are 3,000 junior mining companies worldwide, and I can't follow 3,000 companies. There are new ones that pop up every month, and I hate getting cold called from young brokers, so I'm not aware of all of them. The fact that there are 10 or 12 people out there who are doing my work for me, where I understand their bias, where I know how to consume the information that they send me, is extremely useful for me. If I get an idea from Joe Mazumdar, I think Joe Mazumdar charges $1,200 a year for his letter. If I get one idea from him, that idea has probably saved me $5,000 worth of research. In other words, it's paid for itself 3 times over. Huge deal. If by contrast, I'm asked to subscribe to, the Schlepp, Schmuck, and Schmo newsletter, published from a second floor office over a thrift shop. Probably not much use. Never mind the subscription cost. I don't want to burden myself with having to read it.
So the personal responsibility theme comes through in everything you share, Rick.
Absolutely.
Yeah.
A lot of people want easy answers, and easy answers usually end up resulting in smaller portfolios.
Because most aren't willing to do the hard work.
Correct.
Another theme that you lift up, which leads to arbitrage and opportunities out there for the rest of us.
Right. Well, you need to define who you are and what you're trying to accomplish. I'm not a trader. And I'm old enough and frankly rich enough that, when I was in college, Bill, I was a pretty good trader because I had no money. I had a lot of time. I had a lot of aggression. I had the good fortune of living in Vancouver in the epicenter of junior mining stocks in a real bull market. And I remember very well that my goal in a trade might be 4 snow tires and a date, dinner for 2. In other words, I was extremely focused. And because I was extremely focused, I was an okay trader. But my goal was always to build up sufficient capital that I could be an investor. And when I did that, I lost interest in trading at all.
Okay, on that, do you think you need to bring a trader's mentality, though, for when you see the juniors quickly get overvalued? Do you think that would be...
No, I don't think so at all. If you have... Listen, the price information, which is what a trader uses, is only valid if you have a value expectation. It's the delta between price and value that matters. If I make an investment in something, and one of 2 things happens. Something goes wrong, which is to say that my investment thesis is disproven. I don't care about the price. I sell. It's gone. When the reason to own a stock goes away, the stock goes away. No ifs, ands, or buts. Hope is not one of my strategies. The other thing that happens in bull markets, though, is that your price expectation is met before the company has accrued the value that you think would have justified that price. In that case, you're not a trader, you're a value investor, and you got paid in 9 months what you had expected to take 5 years to achieve. That's not trading. It's pawnbroking. And I am, to be sure, a pawnbroker.
So some of these stocks in the niche metals, like antimony and tungsten, have been on fire, Rick. Like one company, Nova Minerals, NVA on the NASDAQ, went from like $9 to $80 in a matter of like 3 months when the DoD funded it. Did you play any of these niche metals in the DoD funding catalyst?
I have absolutely no fear of missing out. None. So a niche metal where a new producer could crater the market by 50%, or where the promised government support doesn't happen. Government's in the business of lying. Let's get that one straight. Irrespective of what the rewards might be, are not of interest to me. The profits that you talked about are of interest to me. People ask me why I wasn't in Bitcoin. The truth is I was. I bought some Bitcoin in a moment of weakness. I'm a friend of a guy named Tika Tuara, who was a real expert in that kind of thing. I bought some Bitcoin and it promptly went crazy. And I had a discussion with myself. What did I do to deserve this money? What do I know about Bitcoin? What changed other than the fact that the price doubled? And that caused me to sell it. And I'm actually proud of that decision. Now, the people who know that I sold it at $800 on the way to $100,000 will say, don't you feel stupid about that sell? And I said, no, I turned $400 into $800 very quickly. I'm happy about it. And I feel the same way about, amalgamated moose pasture thorium ink. Foregone profits where the profit wasn't at least a strong possibility based on reality as opposed to story. is of no interest to me. They say the three most popular commodities among stock promoters are storium, fraudium, and scammium. And I have no interest in any of those three commodities at all, no matter how strategic scammium might be. The whole government runs on scammium. But despite that, I pay my taxes the old-fashioned way.
So as a staunch libertarian, you are not pro the government funding private industry. However, you've told me in the past with the solar industry, you had to deploy capital there for your clients because the probability of returns were so great, or probable.
There were guarantees in wind and solar. They made it impossible to lose. They gave you upfront tax credits that reduced by 60 or 65% your investment, and then they guaranteed you feed-in tariffs. And on top of that, they guaranteed the debt you took on to private lenders. There was no way in the world, in some of those investments, no way in the world that you couldn't get a 12% return on equity. Now, do I feel dishonest about that? Yes, absolutely.
But you also felt constrained to deploy capital when you saw the opportunity.
There were opportunities to do that in size for a couple of family offices where I could deploy on their behalf $10 million at what was effectively a guaranteed 12% return. My political philosophy notwithstanding, I had an obligation to the client to either do it for them or show it to them so that they could do it for themselves. The attorney, really, truly, the attorney-client relationship is a sanctified relationship, and it supersedes political philosophy.
So when you see like MP Materials, the rare earth project there in your favorite state, mining state of California, where they guarantee a price floor, obviously you're not for that, but how do you think that impacts the market here in the States, the rare earth market?
I don't think it's going to impact below MP an awful lot because there's not an awful lot of real competitive deposits in the United States. By the way, Mountain Pass isn't either. It's been bankrupt 3 times in my career. Investing in Mountain Pass is further evidence that government money is dumb money. The mining business, of course, loves dumb money. There's no greater consumer of dumb money that I know of than the mining business. And the government's the dumbest money of all. So in that sense, it's a marriage made in heaven. What is interesting is that the interest of government in mining tells me a couple things. It tells me that the politics of the United States and popular opinion has changed, particularly in the uranium space. Bill, when you and I first were talking, and I was a very aggressive uranium speculator, uranium was truly hated. And people used to comment on my social media posting saying that I was a despicable human being, that I was profiting off Hiroshima, Nagasaki, Chernobyl, 3 Mile Island, and Fukushima. Now those same people want to subsidize me. That's an interesting change in opinion, which is bullish for the sector. I need to say I felt cleaner when they hated me than I do now when they subsidize me. But I guess, having been in the uranium space for 7 years, that I'm willing to take dumb money too, provided it doesn't come from my clients, at least directly. As shareholders, of course it does.
Rick, you're the largest shareholder of Sprott because you sold your prior business to Sprott. So what is your exit strategy with that position? And does your exit strategy differ or happen before perhaps Sprott creates its own exit strategy?
I think Sprott will create its own exit strategy. Let's say that. Sprott has become one of the 2 or 3 most important brand names in natural resource and precious metals investing. Brand turns out to be important. Sprott is also a unique investment opportunity. Sprott I don't know, you probably have 40 investment vehicles out there, including several publicly traded ones. If you buy one of the publicly traded ones, which I, of course, encourage you to do as a shareholder, one of their ETFs, the silver trust, the gold trust, the uranium trust, any of those things, you get really best of breed product design and best of breed fiduciary management. But you pay them a management fee, let's say 40 basis points. And that goes to the parent company. If you own the parent company, you get an indirect interest in all 40 products. And rather than pay a fee, you get paid a dividend. So from an arithmetic point of view, would you prefer diversification and a 1.8% dividend, or would you prefer single risk exposure and paying a 40 basis point fee? The arithmetic is all around owning the parent. And by the way, while I got a fair bit of stock from selling my business, I sold them two businesses. I sold them what is now their lending business, and then I sold them my business. I've bought stock in the market. I sold some stock a couple of years ago to get myself down below 10%. What was happening was that the regulators, because I was a 10% shareholder of Sprott, were for insider filing purposes combining my shareholdings with Sprott's shareholdings on individual issues, which really constrained my ability to buy and sell stock. So I sold enough Sprott to get myself down to 9.999999. As to your question about the exit, we are in a precious metals and natural resources bull market. Sprott's AUM is growing very quickly. It eclipsed $50 billion US, and the management fees grow commensurate with AUM, which grows much more quickly than overhead, which is very pleasant. The interest and dividends over the last 2 years are up fairly substantially, growing very rapidly. Costs are well under control. I mean, they pay their staff very, very, very well, which they should. They have very high quality people, but the margin increases. What I think happens is that when Sprott AUM crosses $100 billion, that one of the huge financial supermarkets who wants to lumber into natural resources will say, should I spend 5 years and $3 billion establishing market share in natural resources, or should I buy Sprott? And I think Sprott will come to be named Tether or Manulife or Credit Suisse. So I think that my exit will be taken care of in the market.
Not BlackRock?
BlackRock, sure. I don't really think that that's Whitney George's choice. Whitney is the CEO of Sprott. But Whitney is a he's a 5% shareholder or something. He's a large investor in Sprott, and he will do what's right for shareholders. To the extent that a bid comes in that values Sprott fairly, or better yet, unfairly, I suspect Whitney will take it on behalf of shareholders. And I think, no guarantees, but my spidey sense tells me that happens in the 3 to 5 year time frame. It'll be bittersweet for me, I have to say. The whole young team at Sprott, I was around in their formative years, and I love watching them mature. I love watching that team gel. I love Whitney's leadership in Sprott. I love watching the AUM grow. I still, although I don't wear the jersey, I still have it hung up.
Mm-hmm. So what are the companies in your portfolio, Sprott being one of them, of course, if it doesn't sell, like that your trust, after you're gone, your trust will take care of? What are those type of holds in the natural resource sector look like?
Well, not just in the natural resource sector. Battle Bank, I'm celebrating retirement by starting a new bank. By the way, not an activity that's recommended for people who want leisure. Battle Bank, if it outlives me, will likely become a permanent part of my trust. I have a private insurance business it's in the property casualty space around environmental bonding and remediation. It's a permanent business. It's the top of the capital stack in natural resources, even ahead of the secured credit place. me. I suspect, although I don't know, that physical gold, that I'll always have some physical gold. I save in gold. I maintain liquidity in short-term U.S. dollar deposits, but I save in gold, and I have since the year 2000. What I believe it to be a constant. I think that ExxonMobil very well be a permanent portfolio holding for me. I believe in Canada, ARC Resources, as long as the current management team stays in place, will be permanent. I suspect that Freehold Royalty will be permanent. I suspect that Franco-Nevada and Wheaton Precious will be permanent. I'll know within 5 years whether Agnico Eagle will be permanent. It wouldn't surprise me to see BHP become permanent. You'll notice those are all beta names. Those are irreplaceable assets. I think you're going to see a period in time where inflation works through to the upfront capital costs around resource development, which means that existing, built, financed, permitted mines and oil fields with long duration are worth a lot more than the market thinks. Now, if things go crazy, and they easily could in the next 10 years, if things go crazy, and if I'm mentally competent, and if I see sectors that are roundly hated that I understand, some of those positions that I believe are permanent might become impermanent. I'm 72 years of age now. If I was 85, and I thought that Exxon was selling for 250% of NPV, and community bank stocks in the United States were selling at 50% of NPV, if they were hated, after a period of inflation, I'd probably take the money out of Exxon and buy community banks. But X that, which is to say, if the market doesn't get stupid, those would be my permanent portfolio positions.
Yeah. Thank you for sharing that, Rick. You mentioned you're putting money in oil. A large percentage of your portfolio is now in oil. Can you give us any more specifics, like offshore drillers, service providers, Schlumberger or Exxon, Chevron?
I own Schlumberger and Halliburton, but I need to say, looking at my own performance over 40 years, I'm an average allocator in oil field services and supplies, and I'm a good allocator in upstream. So I prefer to be where I'm a good allocator. The names I own there, I won't name all of them because there's a long list, but the principal names, I'm a very large shareholder of Exxon, and I'm bid today. I'm a small shareholder in Occidental. It's got a troubled balance sheet, and I don't like troubled balance sheets, but it's got the best inventory relative to market cap of undeveloped A-grade locations, which I do like. Side note, the United States is running out of high-quality development locations. We've drilled through probably 85% of our inventory, places like the Anadarko and Permian, and Occidental has an outsized share of what's left over. And I own a bit of Chevron because I like the refining and marketing franchise. I've stepped back into Canada in a big way because although I don't like the current prime minister, I like him more than the last prime minister. This guy is Carney, not a good guy, but he's numerate. The last guy was a narrative clown. And I think this guy recognizes that as much as he dislikes carbon, he needs the money because he loves to spend. And I think that pragmatism will allow some headroom in the oil and gas business in Canada. And the Canadian oil stocks are, as a consequence of political risk, much cheaper than the U.S. stocks. So in Canada, I own Suncor, and I own CNQ because you kind of have to. I own Freehold Royalty, which I love. I own Prairie Sky Royalty, which I like, but I like the asset spread more than their track record with regards to investment allocation. I love ARC. I love the management team there. I love Freehold Royalty. I also own Tourmaline, because they're just a serial outperformer. Every year for 10 years, particularly when they do something I don't like and it works, my respect for them increases. And I like the beta in Canadian natural gas. So I own Peyto and Birchcliff, which I think are the two highest quality Canadian natural gas names. I own a smattering of juniors, which I would prefer not to share because people will buy them because I own them rather than doing their own work. And by the way, I've reviewed about 50 juniors in the last year in the oil and gas space. And what I do now is I benchmark them against Exxon. Potential upside, discount to market, potential downside. And invariably, I go to Exxon.
Well, what percentage of the time? Like 98% of the time, or? Okay.
I mean, I can make a case that XYZ Junior is going to go up tenfold, but I can think of a lot of reasons why it wouldn't. I think Exxon is selling at a 40% discount to NPV. I think the nominal oil price goes from 60 to 85. And I think the NPV of Exxon, with the higher oil prices and with the maturation of Guyana and the development locations that they got from Pioneer, I think the NPV in Exxon goes up threefold. So I'm buying a 5-year 3-bagger at a 40% discount to NAV. And by the way, those are probabilistic, not possibilistic. Probable is a way better number than possible.
Thank you for sharing those names and why you're buying them, Rick.
And assuming I'm early, which I always am, the U.S. names I give you a median 3.75% current yield dividend. The Canadian names I gave you give you a 6% basic yield. So assuming that I'm early, which I almost certainly am, the time value of money objection is obviated by the dividend.
So are you more heavily weighted in Canadian then, with the greater dividend, than you are U.S. stocks?
No, I'm much more heavily weighted in the U.S. because of Exxon and because of some other legacy positions. Texas Pacific, BlackRock, the U.S. oil and gas royalty sector. Those are positions that I've had for 25 years. And they became large positions organically. I reinvested dividends and the share price went up. I haven't made new allocations because I haven't had to. But the one I've made the massive new allocations to over the last 3 years has been ExxonMobil.
Flipping back to the precious metal sector, Contango Ore and Dolly Varden Silver are merging. Were you a Contango Ore or Dolly Varden shareholder?
I was a Dolly Varden shareholder. I had been a Contango Ore shareholder. It had very nice initial share price performance. It exceeded every level of greed I had, so I sold the stock. I sold enough Dolly Varden that I was at the point of no concern, but I was a Dolly Varden shareholder at the time of the merger. I recently interviewed both CEOs about the proposed merger. Those who care can find that interview at the Rule Classroom channel on YouTube. Comments on the merger, the market's going to like it. They will, as a consequence of their merger, reduce the combined G&A fairly substantially, which is lovely. The lower G&A relative to AUM or cash flow is a great thing. There are some interesting operational synergies. I don't think that the synergies are as strong as they suggest they are, but that's okay. I hope they can make them work. But the strategy around direct shipping ore and focusing on the North where they're good at, and particularly the admission by Sean Kun that Rick Van Nieuwenhuis is a better guy than he is in terms of taking the mine to production as opposed to finding one, is refreshing. There is an evident respect and regard between the two companies, so the cultural challenges around the merger look like they're going to be small. Larger companies enjoy greater trading liquidity. They enjoy the probability of inclusion in more indexes, and as a consequence of that, greater trading volume, which leads to higher share prices, which leads to lower cost of capital. Now, there are going to be shareholders on both sides of that are disappointed with the outcome. So there will be near-term weakness, but over the course of the year, those people will be taken out, and the greater trading liquidity that they're going to enjoy, as well as the New York Stock Exchange listing and the access to at-the-money ATM financing, means that the transactional cost of capital is going to fall for them from somewhere between 6.5% and 7%, fully loaded, to somewhere around 1%. Our game is cost of capital. You lower your cost of capital, you've done a good job.
Rick, what do you think about Fresnillo looking beyond Mexico into Canada and buying Probe? What's your commentary there?
Idiocy. Maybe it isn't idiocy. There is no mystery over the fact that the family that controls Peñoles, which controls Fresnillo, is held in very low regard by the president of Mexico. And if your primary focus is in a country where the political class doesn't like you, maybe you have to move. I don't know what durable competitive advantage Fresnillo believes that they have in Ontario. I can't imagine it much. I was struck when I saw the news of that merger. I had very recently interviewed Amar Al-Jundi, the CEO of Agnico Eagle. And what he said was that acquisitions for them had to allow them to leverage existing infrastructure and had to build out a greater regional focus. That they had several of what they considered to be durable competitive advantages. One, he considered Agnico Eagle to be an absolutely superior and superb construction company, but one that had particular strength in the Arctic and in the North. He suggested to me that there were opportunities for Agnico Eagle in the greater Abitibi, in Ontario and Quebec, because they had so much infrastructure in place that they could buy a deposit that wasn't big enough to amortize a mill when they could develop the mine without building a mill and truck the material to their own mill. In other words, leveraging existing infrastructure. And he showed me a 5-year roadmap to growth without a further acquisition. I would challenge Fresnillo to explain the acquisition of Probe similarly.
Some say it's because they want to pivot out of Mexico so that Mexico doesn't, pull the rug out from underneath their business. Do you think there's any legitimacy to that?
Sure. They are experiencing antipathy at best from the president of Mexico. And from the point of view of the control shareholder and the point of view of management, I absolutely understand it. From the point of view of a shareholder, I would much rather be invested in Ontario, in somebody that has experience in Ontario. I would point out, too, that the president of Mexico is going to be gone in 2.5 years. She will be a thing of the past. And if well, first of all, I think it is likely that in 2026, at least 6 permits in Mexico will be issued. So the cloud that's overhung Mexico as a consequence of delayed permitting will begin to be used up. Fresnillo will not be a beneficiary of that. Let's get that straight. But what will be evident in Mexico is that mining companies that have demonstrated strong local support, in other words, where the permitting approval will accrue to the political benefit of the president, will be permitted, provided that they have California or British Columbia style environmental practices. And we believe, well, we've been told by good Mexican clients that 6 permits will be issued in 2026, which I think will begin to change the outlook that the rational part of the mining industry has for Mexico. That ultimately could benefit Fresnillo. I believe that North American companies, particularly North American companies where the executives explore Mexico from suburban Toronto will be at a competitive disadvantage to Mexican operations operated by Mexicans. That's one of the reasons that I'm a shareholder in Luca Mining. Luca has, from my point of view, a couple strikes against two small mines, but I own them anyway because Luca has shown the ability to apply the Mexican touch to Mexican assets, to deal with local sociology, presumably including narcotraficantes, to take assets that were misunderstood because they were operated from 3,000 miles away, focus capital and attention on them, and return them to profitability. I think that's going to be a real theme around the world, including in Mexico.
Rick, thank you for your insights and your hour today. Before you go, I know I got an email that the Rule Symposium is going to be in Boca Raton again.
Yes,
Maybe
sir.
share about that with listeners and anything else you're offering, please.
Well, first of all, let's do the free stuff. Anybody who wants to can go to my website, Rule Investment Media, list their natural resource stocks, and I'll rank them for free, no obligation. I'll comment on individual issues if I think my comments might have value. That's ruleinvestmentmedia.com. Please no crypto. Please no pot stocks. Please no tech stocks. Leave an old guy do those well. While you're at it, visit the Rule Classroom. There's over 300 hours of programming here, 15,000 members discussing things absolutely, positively for free. Can't beat free. Free, of course, comes with a money-back guarantee. But the best thing I do is a symposium. That's not free. We've been putting it on for about 30 years. It is the single finest high net worth retail natural resources investment symposium on the planet. It is the only one that makes you the following guarantee, whether you attend live or via live stream. Either are options. We offer a absolutely solid gold money back guarantee. If for any reason you don't think you got your money's worth, we give you your money back. We hold this over 4 days, July 6th through 10, either in Boca Raton or from the comfort and convenience of your own home. And in either case, you'll receive access to the recordings for a year. And you'll need them because we give you 48 hours of programming in 4 days, more than you can possibly endure and absorb. I put on the conference and I have to listen to the recordings. So hopefully, Bill, you'll have a link, but it's Rule Symposium, July 6th through 10th in Boca Raton, either live or via live stream. I encourage live if you can do it. There's lots that goes on in a conference that's informal, at the coffee machine, or better yet, at the bar, in conversations that take place privately at booths or with the speakers. But if you can't make it, I get it. 1,400 people from 33 countries is attended via live stream. And if my memory serves me correctly, of those 1,400 people, 3 people requested refunds. So that was a fairly satisfied group. At any rate, it's the best work I do, a labor of love. We have had outpourings of support from attendees, from exhibitors, from speakers, a veritable love fest. And we'd like you to love us too.
Yeah, no, I enjoyed it. I was surprised how many couples were there. I don't know if people made a vacation out of it in Boca Raton. I didn't remember as many couples in Vancouver when you used to hold it there.
Well, the resort is not a bad place. Central Florida or Southern Florida is hot that time of year. So, when we hold the thing in Vancouver, one problem was it was so nice that people play hooky. They'd walk up Robson Street, have a beer on a deck, watch the girls go by. Nobody in their right mind goes out in Southern Florida midday. But the resort, if you went to book a room there this time of year, it'd be $1,200. And I turned that room to you in July for $320. Because I bring them so many guests at a point in time in the year that's a little soft for them, they give me that exhibit space. They get even with me on the food and beverage, by the way, but they give me the exhibit space, which means that I can lower the cost to attendees. It's all economics. But some spouses who don't attend the conference come year after year after year because they enjoy the place. They enjoy the Atlantic Ocean beaches. They enjoy the pools. They enjoy the spa. They enjoy the restaurants. They just enjoy the whole experience. It's a hell of a resort.
Yeah, it was very nice. Well, thank you for your insights today, Rick.
Pleasure, Bill. Thanks for the opportunity to visit with your audience.